Oh boy, you just can't make this stuff up. Oh, one of my favorite sources to go to find bears. Well, there are actually two of them. One is T.S. Lombard, and the second is the Greed and Fear Index. And both of them have pieces out that just made me laugh. And I'm really not trying to rub salt in the wound, but I'm actually legitimately starting to get concerned that being a bull is about to get very crowded because I'm concerned that the bears are all going to flip over and then we're going to have a bubble market and then I'm going to have to become a bear again and flip flop. This is crazy. But listen to this. I literally had to write, what the F on this document. What the F? I kid you not. T.S. Lombard, a great resource for looking at the bears lately, has just said the following. To manage the near term risk of a melt up, we add to equities and go neutral. You should be laughing your butt off right now. The Bears at TS Lombard literally just said, well, even though we're Bears, because we're missing out so much, we are going to add to our stock positioning because the market's going to melt up if we don't. Well, the market's going to melt up if all the bears flip flop over because they realize they've been wrong. But oh my gosh, this is remarkable, especially when you combine this with what we talked about in the Bank of America Fund Survey the other day. In fact, towards the end of this video, I'll include what we talked about in the B of A Fund Survey. Positioning is so low in equities right now that of course the bears have to flip. But let's take a look more at this. Let's give the article some respect here beyond, well, what I just did. Anyway, equities continue to price in a soft landing scenario, which in our view is still elusive. The US recession remains a consensus view. Right. So because a recession is so for sure going to happen and the Fed's going to commit another policy mistake, of course the best thing to do right now is to add to equities because, well, prices are going up. I mean, it's just becoming an eye roller. But let's look a little bit more into their detail. So here are their rationales. So first, they say the recession is in the cards because of the delayed impacts of tighter monetary policy. We've heard that argument a million times before. Inflation has started to surprise to the downside. Oh, darn it, that doesn't feed into the bear narrative. It actually encourages assets like stocks to go up, especially wages being subdued, meaning no wage prices. And guess what? Oh, yeah, risk assets tend to perform well during disinflationary periods. And darn it, there might even be some short squeezes. So, you know what? We're just going to have to increase our equity allocation. Okay, that defies logic if that's really what you believe, but okay, continuing on. But we do think a recession is going to happen because of, oh no, the inverted yield curve, oh no, and the refilling of the TGA, which we already know the refilling of the TGA, liquidity pain was a total myth. It's just coming straight out of the reverse repo facility. Basically, people are like, oh no, there's a lack of money at the Treasury. And then people who are actually looking at the data are like, dude, there's over $2 trillion sloshing around in the reverse repo facility. The Fed could go like this and lower reverse repo rates if they needed to, and that liquidity would be totally in balance again. But guess what? They don't even need to because there is no liquidity crisis. It's just ridiculous. Anyway, if the US does indeed go to a recession, it's difficult to imagine the rest of the world not catching the proverbial cold. So here they're basically saying if the United States sneezes, everybody else catches a cold. And it's a way to say, like, this is why we're still bearish on stocks, because you have to be bearish because if the US goes into recession, everything's going to get sucked into this void of hell. And so then they argue, but if we do get a recession, the Fed will probably cut rates aggressively. But of course, because we're bears, that's going to be negative at first before it's positive. Rate cuts would not be a good thing, at least initially, because stocks are going to sell off during the re-steepening of the inversion of the yield curve. Right. Just like stocks sold off in March during the banking crisis and the yield curve inverted 50 basis points in the matter of 2 days. Oh, wait, stocks were flat and then skyrocketed thereafter. That's right. They didn't actually go down. Okay, anyway, the problem with this logic is that when a recession starts, it's difficult to know for sure when it'll end. So maybe, even though some people think they can just look through a mild recession, things might end up really, really bad because it's uncertain to know when the recession is going to end. The bears are now resorting to, okay, all right, maybe stocks won't go down in the initial part of the recession, and in fact maybe things won't actually be that bad because after all Germany's in recession and their stock market's at an all-time high, New Zealand just entered into a technical recession and their stock market's barely down, like a few percentage points. So maybe going into recession isn't the bad part. Maybe it's the fact that once we go into a recession, we don't know when it'll end. And yeah, that'll be the bad part. But in the meantime, we're still going to buy stocks. This is like this is an embarrassing piece. This is an embarrassment to the Bears. I'll get to another piece in just a moment. I want to talk about their downside risks here, and then I want to. So there are 2 more pages, 3 more pages here, and then we're going to jump over to the greed and fear in paper, which is actually a pretty good paper. But we'll go through what they're saying. They're also Bears, but anyway. So what do you say here? Oh yeah, don't position yourself for defensive stocks, which would be like your healthcare and utility stocks, because the recession might not come soon enough for the defensives to play out. Ooh, that's probably bad for staples as well. And missing the late stages of an equity rally can lead to massive lost returns of in the S&P 500, 13 to 9%. Oh, so that's why you guys are increasing stocks purely because, or your stock allocation purely because of FOMO. Darn. Also, you have S&P positioning right now that is the shortest since 2007, and institutional investors are pretty mispositioned. So really what you have is you have a lot of shorts and a lot of mispositioned funds that are literally punching the air right now going, this can't be. This was supposed to be a hellish market, and it's all going good. In fact, when I launched my ETF, people were leaving me comments going, you're an idiot. 2023 is going to be the worst year in a century. And I'm like, bring it on. It's been like straight up from there. Whatever, man. So individual investors have turned bullish, albeit somewhat slightly over here. Institutional investors, the ones with the big dollars, are missing out. And so now TS Lombard says, well, mind the short squeeze because the short squeeze is going to cause more FOMO and blah, blah, blah. Okay, let's go jump on over to TS Lombard. Sorry, this is TS Lombard. We're going to go to greed and fear. But quickly, they say the building out of a bubble is starting. This is like the classic bear argument. When the bear is wrong for too long, they just start punching the air again, screaming, well, fine, maybe I was wrong, but now it's a bubble. And so the ingredients are a good fundamental story, a compelling narrative to justify future growth, and liquidity or leverage to take on speculative risk taking. They suggest that AI seems to be the place for that. To some extent, I think that's going to actually be true. I think that there will be a bubble in software AI. I don't know that we are yet at liquidity or leverage because I don't think individual or institutional investment liquidity is that great right now for equities. So I'm not convinced that we have all 3 pieces yet, but I do think eventually there'll be a software bubble. So what do we have here? Here's the greed and fear document. There is no doubt that the pain trade is getting more painful for those equity investors still defensively positioned as confidence grows that AI provides the next productivity enhancing narrative. In other words, it sucks to be a bear right now, especially since AI conveniently happens to also be disinflationary. Greed and fear has to admit again. Remember, they're bears, okay? They've been bears. Greed and fear has to admit again that this is indeed a powerful narrative which the cautiously inclined need to treat with respect. In other words, all the bears need to respect the rally because it might actually have legs, especially the pick and shovel themes like chips or designers for chips like NVIDIA, chip manufacturers. We've been saying that for about 9 months. But okay, all right. What else do they have to say? Okay, they talk a little bit about Microsoft and Apple here. Okay, here we go. Now, the core issue in the coming months is which part of the Fed's dual mandate the Fed will prioritize. Will they prioritize inflation or employment? In other words, if unemployment starts rising, will they blink and cut rates? And they believe the chance is that they're going to favor preventing unemployment and they'll become more patient with inflation. In fact, some will make the argument, which is likely a good argument, some will make the argument that right now the Fed is being so aggressive on inflation because they have the liberty to be, because we don't really see the massive job losses yet. Yes, there have been job losses, but they have not been to the level of massive yet, or really rising unemployment above 4%. Then we've got bank deposits starting to rise again, so the banking crisis somewhat coming to an end. On page 14, they talk about Chinese consumers being risk adverse and this Chinese slowdown. Yes, we already know that. And then, of course, they talk a little bit about this shadow banking crisis, about how half of the world's financial assets are controlled by non-bank financial systems. Really, at this point, what you're saying is the bears, for greed and fear at least, it's kind of embarrassing, but honestly, I'll highlight it here for you. This means that if there is a real problem lurking, the world is likely to find out about it after the event and not before. And that's actually how they end their bear piece. So think about that for a moment. The bears are literally, on one hand, you have T.S. Lombard that's like, we're such bears, we're going to buy stocks. And then you have the greed and fear index, those folks who are real big bears going, yeah, this rally has legs, but did you know half of the world's financial assets were controlled by non-banks? Doesn't that sound like a black swan to you? And then they slam the door shut, and it's like, dude, that's not a valid conclusion. Anyway, I want to play a little bit from the Bank of America Fund Manager survey, so let's jump into that. But I'll tell you, this is just getting hilarious. Now we've got to cover what fund managers are allocating to, and Bank of America just released the fund manager survey for this month, and they give us some pretty good insight in terms of at least where registered investment advisors are allocating their clients' capital. And what I like to do is I like to be the contrarian. I like to look at this and go, okay, where are things crowded so I know not to go there? And so let's go through some of the individual sections that I've highlighted. The first, and this is not a surprise, we started making fun of this probably around 2 months ago. We started arguing, just wait. You're going to start seeing the recession calls for Q3 get delayed to Q4 and then Q1. And literally look at the fund manager survey here. Start of recession punted into Q3, Q1 2024. It looks like you have most people targeting, at least from the fund manager survey, about 33-ish% of folks looking at a recession in Q4, and then about 25% in 2024, with 14% of fund managers seeing no recession in the next 12 months. Now, note here, you do have this optimism that seems to be slightly balanced between hard and soft landing when you look at the June and May survey. As far as where the bias is, though, it's definitely towards a soft landing. The hard landing narrative only resonates with about 26-27% of fund managers. And but most people are expecting a soft landing, which means not a stronger economy. That's important to consider, because if everybody's thinking of oh, everything's gonna be stronger, everything's gonna be better, that becomes widely bullish. So soft landing shouldn't be considered stronger. It should just be considered not recession but slower, right? So any kind of revisions to the upside where you actually do end up having a stronger economy would not yet be priced in, at least according to fund manager allocations. This is where you have that Chinese optimism flipping back to pessimism. This is something we talked about actually over here specifically. I called the Chinese reopening clickbait. And the reason I called the Chinese reopening clickbait is because, first of all, nobody knows clickbait better than I do. And so when I saw it, when I saw the setup for this Chinese stuff, I'm like, oh, yeah, that's clickbait. There's no way with the lack of savings that the Chinese have relative to Americans coming out of the lockdowns, there's no way you're going to get this insane boom in China, and that'll end up driving inflation like people expected. Now, what you have now is basically optimism shifting to pessimism. But on top of that, yesterday you had an announcement of some rate cuts from the Bank of China. And so the People's Bank of China. So what you ended up seeing is you actually saw oil move up about 3% just on the day yesterday. Because China is now resorting to stimulus to try to basically help the Chinese get it up, and the pricing power is just not happening right now. You're also seeing some of that more luxury spend, that luxury discretionary spend, start showing cracks, and China can be one of the reasons for that. Here's another one. This was just 15% expect stronger economic growth. I find that quite interesting. This right here is remarkable because and Steve here asks, you don't think the government is going to stimulate in China? No, 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 they will. The government will stimulate, but remember that Chinese stimulus is different from American stimulus. Chinese stimulus is usually infrastructure spend or corporate stimulus. It is rarely consumer stimulus, and that is a very different, slower moving animal when you stimulate businesses and infrastructure compared to the consumer, which is a very quick and very spendy animal. Anywho, looking over here, just 15% expecting stronger economic growth. That's a really low number. Again, that in my opinion means markets still today, even after the stock market rally, are actually not pricing in the potential for a stronger growth set, which is remarkable. Um, no, PayPal's not pricing in 6 PE. Yeah, I mean, if you go forward very, very far, maybe. But for the end of this year, PayPal's pricing in, just as a tangent, somewhere around a 12 to 13 PE ratio, which puts you at about a peg of 1. But again, if the growth of PayPal evaporates from 10 to 12% down to 5%, then you're actually starting to look, then you may as well buy Tesla at a 2 peg, right? Or a 2.4 peg. So keep that in mind when you're doing your growth valuations. Something obviously we regularly talk about, of course, in the programs on building your wealth, which is the perfect time for me to remind you about these 4 phases of price increases we have coming. This is going to be a reward to all the existing course members, as we've got large sets of new lectures coming out for stocks and psych. We're adding AI, real estate 0 to millionaire, adding AI, and then more AI lectures in the making more money in the productivity course. But we're going to have 4 phases of price increases. The first price increase will occur on June 16th. So check that out. I'll link it down below if you want to lock in the best pricing. Okay, back to the fund manager survey. This lack of really pricing in a strong economy is shocking to me. You have a net negative 62% expectation for a stronger economy being priced in. That's a sign of really, if we get growth this year and next year, people are vastly mispositioned. Still today, this is a survey that just came out, and despite this stock market rallying, you still have a mispositioning. Only 2% of investors actually expect higher inflation. Inflation's basically over, but the question then is, okay, well, how long is it going to take to get inflation down? That's the real question now. So you've got this idea of the Fed flip-flop here. How many people actually think the Fed is done? Only about 32% of fund managers actually think the Fed is done. That's a flip from what we saw in May. But as of June, most people think the Fed is actually going to hike again in the future. So we'll find that interesting. First Fed rate cut expectations. Most rate cut expectations are sitting in Q1 2024. So no more rate cut expectations set for 2023 here or here. You can see those are relatively low, although there's still that chance for the end of the year. Okay, continuing here, we have investors wanting companies to increase capital expenditures at the highest level since September of 2022. Actually, not too terribly long ago, but you're still seeing more of this, likely because of artificial intelligence, a desire of fund managers to see companies invest in their companies rather than just save money and increase cash. Although improving their balance sheet still very, very important, which is the blue line here. Cash level, you can see cash levels slowing a bit. We're still above the longer term average of where cash levels sit. The longer term average is the lower red line, and where we sit right now is the upper red line. So right here in between, if I shade this in, this shows you your excess cash position compared to history, according to fund manager allocations. So a little bit higher on cash allocation than expected. These are month over month changes in investor positioning. You could see investments, alternative investments, actually seeing a little bit of a rise. This could be like your gold, for example, and real estate, whereas a lower on cash for allocations. Jumping in over here, investors on bonds. Less interesting over here. In fact, I'm just going to move forward to over here because we have a different segment that talks about bonds. So this chart, fascinating compared to the last ones I just skipped here. This chart, fascinating. This shows you investor fund manager allocation to technology stocks versus energy stocks. And what you can see is technology stock allocation hit a peak in April of 2020 during COVID lockdown period and September of 2015. But if you draw a longer term average of where technology allocation has been between 2010 and 2020, ignoring the 2000s dot-com bubble disaster and the Great Recession, you can actually see we're allocated somewhat on the low side relative to where we have been in the last decade. And frankly, I would make the argument that inflation, or rather technology allocations today, are much more important. That's what I wrote here in the red. Much more important today than where they were in the last decade. So I think this low allocation to tech is a mistake. I started highly allocating to tech really in this November area over here. I even created a fund about November 30th that was highly allocated to chips and technology. At the time, everybody made fun of me for it, but I guess that's the way it works. So anyway, unfortunately, this one bothered me. They indicate that even though allocations to equity are low and growth expectations are low, the most crowded trade right now as of June 2023 is being long technology. So I thought, okay, does it make sense to allocate a little bit more again to the US dollar? And while I considered that, I realized you have a large opportunity cost of allocating to the dollar or treasuries, given the potential rise in equities. So that is a risk. Now, this was about the opposite that I thought. So it actually still is. So this right here shows you the worries that fund managers have for the market. And what you actually see is fund managers are most worried with about a 35% worry level of high inflation keeping central banks hawkish, followed by a global credit crunch at about 22%, geopolitics worsening at about 16%, some sort of black swan at 12-13%, and AI being a bubble at just 9%. I was actually slightly the opposite of this. Now, that's crazy to think. Oops, I knocked over one of my lights. Anyway, so I was the opposite of this. The reason I was the opposite of this is because I'm not terribly worried about this. I think that this is clickbait. So I'm going to break this down here. And this is what I think is incredible because you kind of want to see where you're different. So I found this to be, in my opinion, clickbait. I also think this is clickbait, which is the credit crunch. So in other words, this higher for longer nonsense and the continued hiking, I think these two are clickbait. I'm kind of neutral on Ukraine and Russia and the impacts on the market, as well as this systemic event. I'm actually more concerned about an AI bubble. And the reason I'm more concerned about an AI bubble is I think that people are really misallocating to software. I think that a lot of fund managers don't know anything about artificial intelligence and don't realize to some extent, and it depends on the type of application, to some extent how easy OpenAI and some of these language models have made it to create an AI startup or AI software. And an example I'd like to give you is Snowflake, and this hasn't played out yet, but consider this. C3 AI has been running on this idea that it's enterprise AI, and they have a moat in enterprise AI, and nobody's better than C3 AI at enterprise AI. So what does Snowflake do yesterday? They come out and announce enterprise AI, and it made me think, wow, that here's a direct risk and now a direct competitor to companies like potentially a Palantir or a Snowflake when you have, or sorry, not Snowflake who announced it, was Salesforce. Here's a direct competitor to Snowflake and Palantir and C3 AI. Salesforce, just boom, now we have enterprise AI. And the reason I say that is these companies have so many massive teams dedicated to creating the software suites that people are going to spend money on. That software competition for enterprise AI is about to explode. And it's actually going to give the government substantially more choices in determining what's best for them. That's a competitor to Gotham for Palantir. And it's also going to create competition for Foundry over at Palantir, which is their commercial enterprise segment. And my point of this is I think fund managers are over allocating to software when it's really unclear who's going to win from the software AI led revolution. And I'm not going to make bets on software. I've actually been reducing my exposure to software because I think it's too bubbly and frothy. I would rather allocate more to chips and chip manufacturing than software. I could end up being wrong about that, but I don't think I will be because I don't think any of us know who is going to profit the most from AI. And remind yourselves of that. I'm not saying who's going to have the most customers or who has the best software. We're going to say who's going to profit the most from the software. That's a very different question. And that is a question that I remain unconvinced on because the barriers to entry are like nearly zero. And it depends what you're doing with AI, right? That's where the barriers, because if you have to train a model and your IP is the way you've trained a model, then that's unique. But if your IP is, well, we'll make a software suite for you so you could use ChatGPT, you have zero moat, and quite frankly, you deserve virtually no profit. So it depends what the offering is, I suppose. Okay. Speaking of offering, have I shown you the price increase schedule? How we're raising prices in 4 phases for the courses on building your wealth? People ask me, Kevin, why are you raising prices? You're contributing to inflation. First of all, I'm not because I'm not in this inflation report. uh, Otherwise, I suppose I would be. But second of all, we keep adding more value. So if you adjust for the value we're adding, the courses are actually deflating. Even though the nominal prices are going up, the value you're getting is going up it's so much more that your nominal payment is actually less, or the real payment. There you go. That's the way to put it. The real payment is actually less. So risk barometer, you could see some more risk appetite coming in for fund managers. Look at this, folks. Look at that rotation away from staples and cash. We saw this coming a mile away. Finally, you're seeing that walk away from staples over here. Finally. Look at these fears. Now, if there's one chart that made me very, very excited, it was this. Look at it over history. Fears plummeting in the fund manager survey. Like, if you go to the bottom of this, look at some of these fears. EU sovereign debt funding crisis, the collapse of the EU, Chinese hard landing, geopolitical crises, US fiscal cliff. This is all back to 2013, 2011, 2012. EU is going to fall apart. Oh no, the Fed in 2018, the trade war, COVID. And if you actually look at where we sit on the fear level right now, if I take a big highlighter and draw it through the sort of fear level, we probably sit right about here, which is a little bit on the lower side of fear for high inflation and a credit crunch or a systemic credit risk or whatever, or hawkish central banks. We're actually not that fearful right now. But not only are we not that fearful with fund managers right now, look at these asset allocations here. These show you. Now, this is a little complicated to read, and I got to be quick because we got PPI coming out. So, you ready for this? Let's summarize this quickly. See the blue line? The blue line are stocks going up. See the light blue section right here? Those are allocations. Fund manager allocations to equities are 32% underweight. That means there's still a ton of money sitting on the sidelines to go into stocks, which is insane. In fact, these fund managers are still overweight bonds. See that the little blue lines over here? They're still overweight bonds and they're still overweight cash. A lot. This is insane how much fund managers are still underweight equities. Even though they've gone bullish long tech, they're still way underweight equities, which is mind blowing to me. You're underweight real estate and equities. Well, we got to talk real estate as well. There's some real estate opportunities. And then global tech. Global, that's different because you get the emerging markets built in there. Still low, but a little bit more allocation to global tech compared to just American tech. So, bottom line, when you look at this fund manager survey, what do you get? Well, the fund manager survey is screaming at you that finally fund managers are realizing you have to go long US tech, but they're still way underweight US tech. There's still a lot of money sitting not just on the sidelines for cash, but in bonds. And I think as we start seeing real estate liquidations from institutions, which we're starting to see, you'll see more money flow into equities. And that's all very supportive to equities. Even though things feel somewhat bubbly right now, It's actually a lot of tailwind still behind us, which is insane.